A very warm welcome back to all of our amazing listeners. You're tuned in to Money Talks, the podcast that loves to make money matters simple, approachable, and maybe even a little bit fun. Have you ever been there? You're scrolling through your social media feed and you see a friend post about their stock market wins, all those green charts and exciting gains. And in that moment, you feel that little pang of, ugh, when am I ever going to get started? Maybe you've told yourself, I'd love to invest, but I don't have a huge chunk of money. Or the market is so volatile, it seems like a scary roller coaster. Or perhaps you think it's just too complicated, a world reserved only for experts who understand all the jargon. These worries can feel like a huge wall keeping you from building your own financial future, right? Well, what if I told you there's a way to invest that feels less like high-stakes trading and more like dropping coins into a savings jar every month? A method where you don't need a big starting sum, you don't have to stress about finding the perfect time to buy, and most importantly, one that lets you sleep peacefully at night without worrying about the market's daily mood swings. Think of it like planting the seeds of your financial future. You water it a little bit, consistently, and just let it grow strong and steady over time, eventually bearing fruit for you in the long run. This wonderfully simple and powerful investing method has a cool name, DCA. And today, we're going to get to know our new best friend, DCA, a whole lot better. What exactly is it? How does it work? And how can it transform the intimidating world of investing into something easy and stress-free? Let's find out together on today's episode of Money Talks. All right, so now that I've hopefully sparked your curiosity about this friendly approach to investing, let's dive right in and properly introduce you to our new buddy, DCA. DCA stands for dollar cost averaging. I know, the name sounds a bit technical and formal, but I promise you, the idea behind it is incredibly simple and down to earth. At its heart, it's all about averaging out your purchase price. The whole strategy boils down to just 3 simple rules: investing the same amount of money at the same time on a regular basis. That's it. You do this consistently, whether it's weekly, bi-weekly, or monthly, without paying much attention to whether the market is having a great day or a really bad one. Essentially, you're taking emotion completely out of the picture. To make this crystal clear, let's paint a picture. Imagine we decide to invest in a hypothetical fund we'll call the Happiness Fund. Sounds nice, right? Our plan is simple. We're going to invest $100 into the Happiness Fund on the first day of every month. Let's see how that plays out. Month 1. On January 1st, the price of the Happiness Fund is $10 per unit. Our $100 buys us exactly 10 units. Simple enough. Month 2. The market takes a little dip. On February 1st, the price drops to $8 per unit. This might seem scary, but we stick to our plan. We invest our $100. And look what happens. This time, we get 12.5 units. Month 3. The market is feeling optimistic again. On March 1st, the price rallies to $12 per unit. We stay disciplined and invest our $100, which gets us about 8.33 units. Month 4. Things level out. On April 1st, the price is back at $10 per unit. We invest our $100 and get another 10 units. Now, did you see the magic that just happened? During the month, the price was lower, our fixed $100 bought us more units. And when the price was higher, it bought us fewer. When we add it all up, we've invested a total of $400, and we own a total of 40.83 units. This means our average cost for each unit isn't 10, but about $9.80. We've automatically bought more when prices were low and less when they were high, bringing our average cost down. That's the power of averaging. So why is this approach so fantastic and friendly for new investors? Because it solves the single biggest headache in investing, trying to time the market. The truth is, nobody on earth, not even the most famous financial gurus, can perfectly predict the best day to buy and the best day to sell. Trying to do so is stressful and incredibly risky. DCA steps in like a hero and says, you don't have to guess anymore. By investing consistently, you remove emotion from the equation. It helps you conquer the two biggest enemies of any investor: fear of buying at the top, fear of losing money when the market drops, and greed, the desire to get rich quick. DCA acts as your emotional shield, allowing you to build wealth systematically and with peace of mind, making it a sustainable strategy for the long run. All right, so now that we've been properly introduced to our new investing buddy, DCA, and we understand its basic game plan, it's time to get to know it a little better. Think about it. When you're making a new best friend, you love all their amazing qualities, but you also get to know their quirks, right? The things you need to be aware of. Well, it's the exact same with an investing strategy like DCA. It has some absolutely fantastic benefits that will make you want to start today, but also a few things to keep in mind so you can go into this partnership with your eyes wide open. Let's kick things off with the sunny side, shall we? Here are the brilliant benefits of DCA that will truly make you smile. First up, DCA is a phenomenal tool for building financial discipline. Let's be honest, sometimes it's just so easy to spend money on that extra coffee, a new gadget, or a fun dinner out with friends. Before you know it, the end of the month arrives and your savings account is looking a little lonely. But when you set up DCA, especially with an automatic transfer, you're essentially paying yourself first. It's like having a friendly personal trainer for your finances, making sure you set aside money for your future before you have the chance to spend it elsewhere. This simple, automated habit builds a powerful foundation for long-term wealth without you even having to think about it. The second amazing benefit is that DCA makes investing truly accessible for everyone. It completely shatters that old myth that you need a ton of money to get into the market. You don't have to wait until you have thousands of dollars saved up. Many investment platforms and funds today allow you to start with as little as $20, $50, or $100 a month. That's it. By redirecting the cost of just a few fancy coffees or one less takeout meal each month, you can start building your investment portfolio. And here's the secret sauce. Starting early with small, consistent amounts often leads to better results in the long run than waiting to invest a big lump sum later on. And here's the next big one, which might just be my favorite. DCA is the ultimate antidote to market anxiety. Forget that image of a stressed-out investor glued to their screen watching charts go up and down all day. You can say goodbye to that constant worry of, is now the right time to buy? Or, oh no, the market is down, should I sell? Your job is simply to stick to the plan. This consistency frees you from the emotional roller coaster of trying to time the market, which, let's be real, almost no one can do successfully. It allows you to invest calmly and rationally, which is a total game changer for your peace of mind. Finally, DCA gives you a psychological superpower. It changes how you see market downturns. For many investors, a falling market is a source of panic. But for a DCA investor, it's an opportunity. Think of it like your favorite store suddenly announcing a massive sale. When prices are lower, your fixed investment amount automatically buys you more shares or units. You're getting more bang for your buck. This simple shift in perspective can turn fear into excitement, helping you stay invested and even benefit from the dips that scare other people away. Now, to be fair and balanced, let's talk about the other side of the coin. DCA is fantastic, but it's not a magic wand. Here are a few things to keep in mind. First, in a market that is going straight up without any major dips, what we call a strong bull market, DCA might actually result in slightly lower returns than if you had invested a large lump sum right at the beginning. This makes sense, right? Because you're averaging your cost upwards as the price continues to rise. However, since nobody can predict when these nonstop rallies will happen, DCA remains the safer, less stressful bet for most people over the long term. Second,
And this is super important. DCA is the how, not the what. It's a method of investing, not an investment itself. The success of your DCA strategy completely depends on you choosing a quality asset to invest in, like a well-diversified index fund or a solid company with long-term growth potential. Think of DCA as the car. It's a reliable vehicle to get you to your destination, but you still have to choose the right road. If you consistently invest in something that has poor long-term prospects, you won't get very far. And lastly, DCA is a marathon, not a sprint. This is a strategy designed for the long haul. You won't see dramatic results overnight. It's all about consistency, patience, and letting the power of time and compound growth work its magic. So if you're looking for a get-rich-quick scheme, this isn't it. This is about steadily building wealth over years, not days.
Okay, if you've been listening along, there's a good chance you're feeling that little spark of excitement right now, thinking, yes, this is the investing method I've been looking for. But at the same time, a little voice in your head might be whispering, so how do I actually start? Please don't worry, because getting your DCA plan up and running is so much easier than you think. Today, I'm going to break it down into a simple 5-step checklist that you can follow to get started right away. Step 1. Define your why and get to know yourself. Before you start any journey, you need to know your destination, right? Investing is exactly the same. So take a moment and ask yourself, what am I investing for? Is it for a comfortable retirement in 20 or 30 years? Is it for a down payment on your dream home in the next 5 years? Or maybe it's for your kids' future education. Having a clear goal is what will keep you motivated. Next, do a little self-check-in. How do you feel when you see numbers go down? This is what's known as your risk tolerance. And finally, the most practical question, how much play money or disposable income can you comfortably and consistently set aside each month without impacting your daily life and bills? Step 2. Choose your investment vehicle, your travel buddy. This is the step that worries most people. But for beginners, I have a beautifully simple recommendation. Start your DCA journey with mutual funds or ETFs, exchange-traded funds. Think of a mutual fund like hiring a professional chef. Instead of you having to pick out every single ingredient or stock, a professional fund manager does it for you. These funds automatically spread your money across dozens or even hundreds of different investments, which is a fantastic way to diversify and lower your risk compared to putting all your eggs in one basket with a single stock. A brilliant place for beginners to start is with an index fund. An index fund is a type of mutual fund or ETF that aims to mirror the performance of a major market index like the S&P 500. By investing in an S&P 500 index fund, you instantly become a part owner of the 500 largest companies in the US. It's a simple, low-cost, and incredibly effective way to grow your wealth as the overall economy grows over the long term. Step 3. Open the door to the investing world by opening an account. We live in an amazing digital age where everything is at our fingertips. Opening a brokerage account to buy funds and stocks is incredibly easy. You can often do it right from an app on your phone through established firms like Fidelity, Vanguard, or Charles Schwab, or even through newer user-friendly apps like Robinhood or M1 Finance. The process is quick, requires just a bit of personal information, and in no time at all, you'll be ready to make your first investment. Step 4. Automate everything and build effortless discipline. Now we get to the absolute heart of the DCA strategy. This is where the magic happens. Once your account is open, you need to set up an automatic investment plan. A great little life hack is to schedule your automatic transfer for a day or two after you get paid. That way you're paying your future self first before you even have a chance to spend that money on something else. Log in, choose your fund, decide on your amount, say $100, and set it to automatically invest on the first of every month. This creates a powerful set-it-and-forget-it system that builds discipline without you needing any willpower.
Step 5. Check in and review. Like an annual health checkup. Now, when I say set it and forget it, I don't mean you should literally forget about it for 30 years. It's wise to check in on your portfolio at least once a year. Think of it as an annual health checkup for your investments. You'll just want to make sure the fund you chose is still performing well and that your financial goals haven't changed. Life happens. Maybe you get a raise and want to increase your monthly contribution. This annual review just ensures your investment plan continues to align with your life. And that's it. Just 5 simple steps, and you can start building long-term wealth using the calm and consistent power of DCA.
And there you have it, our deep dive into the wonderful world of dollar cost averaging. As you can see, DCA is a beautifully simple yet incredibly powerful strategy. It's a method designed for everyday people like you and me. It's perfect for beginners who are just starting out, or for anyone who has a busy life and doesn't have the time or desire to be glued to financial news all day, but still dreams of building a secure financial future. I want to leave you with this final thought. The true genius of DCA isn't about trying to outsmart the market or chasing the highest possible short-term profits. Its power lies in discipline and consistency. It's about trusting in the process of long-term growth, being patient, and letting the incredible force of compound interest do its work over time. Remember, starting today with a small amount is always better than waiting for that perfect day when you have a large sum of money to invest. I truly hope that today's conversation has sparked a little inspiration and given you the confidence to take that first step. Don't let fear or uncertainty be the wall that holds you back from your financial goals any longer. Let's start planting those seeds for our future wealth together. For today, that's all the time we have here on Money Talks. Thank you so much for listening and for spending a part of your day with me. Be sure to follow our podcast so you don't miss out on more simple, friendly money tips in our next episode. Until then, take care and we'll talk soon.